Good morning, everyone. Tim Nyland here, Zacks Professional Services. This is our weekly internal strategy call, and today is Wednesday, November 4th, the day after the election. And if you can hear it in my voice, what a night it has been. And obviously, we still don't know the winner of the election, but the stock market seems to be very happy with the fact that it looks like we're not going to have a blue wave, and it looks like we've got a stalemate in Congress in terms of getting any sort of legislation passed, with the Congress still divided, Republicans retaining control of the Senate. So obviously a huge boost to technology stocks. We're seeing that today. The real winner in last night's election is the earnings certain portfolio with the tilts. And before we start talking about the ISM number, I did just want to show the tilts very, very briefly. Many of these names up over 7%, but obviously for anybody that's running a 20 to 30 or even percent more tilt strategy along with their core equity positions, hopefully the earnings certain portfolio, you can see that we're just getting a ton of return here today, which is great. These names have been under a little bit of pressure, but obviously, the odds of there being a blue wave and all this stimulus and this massive value rotation and all this, energy and infrastructure and everything being passed under a Biden presidency and a Democratic Congress appears to be kind of had some cold water thrown on it. So we'll see what happens. But as I just pan through, the members of the Admiral portfolio and the ECP 75 core, I just see an absolute sea of green. And even more so if we just take a quick look at the sector spiders. We know the sectors that we avoid in core, and obviously financials are red today, so that rotation is unraveled now. Energy's up just a touch, utilities are about flat, but obviously the big winners are where we're weighted, and that's communication services, obviously with Facebook and Google in there. Consumer discretionary, we obviously tilt up with Amazon here. The technology sector, 3.85%, which is huge. Select industrials, and obviously healthcare is really up today, 5.44%. So some big wins for the earnings certain family of portfolios along with the tilt strategies. And so with the election this week, I want to start out by talking a little bit on the macro side, and then we're going to jump in and actually do some securities analysis and take a look at what's going on in this cyclical patch. We had an absolutely spectacular ISM Manufacturing Index number, specifically the Purchasing Managers Index number, come in this week at 5930. And once you start approaching 60 on the ISM Manufacturing Index, and you can see that up here, I can actually display the data. And again, we're in the Zacks research system now. These numbers we are planning to add to advisor tools along with several other key macro level manufacturing indices. But keep in mind that anything above 50 is expansionary, anything below 50 is contraction, and that can be the same can be said for the ISM Services Index. We call it the non-manufacturing. And I'm going to go ahead and hide this data so it's not a distraction. And so once you start getting to 60, and again, keep in mind that this more or less oscillates with the business cycle and the economy, it gets really, really challenging to sustain that. And so the very first thing I want to comment about this 59.3 number is it's absolutely spectacular. And, we can go higher, but chances are it's not going to stay there if we do. So just be advised that these things tend to roll over. I'm not sure how long this expansion is going to last. I don't think anyone does, but it's huge. But the bigger story that's not being discussed is the fact that the Federal Reserve has done a really, really nice job of basically nullifying the effect of this fallout from the COVID sell-off. In other words, you could pretty much just draw a trend line right through here and see that we have literally made up for, in terms of manufacturing, the COVID crisis, and we've actually gone well beyond that. And when I look at this chart, the very first thing that should come to your head, it comes to my mind first, is we need to look at what's going on in the cyclical patch. Because the ISM Manufacturing Index is all about manufacturing. It's all about industrials and either expansion or contraction thereof. So the first thing that comes to my mind is like companies like Caterpillar and John Deere. And I know there's been a lot of play, in the media, CNBC, everybody's saying now's the time, now's the time, now's the time to consider this value rotation, to consider rotating into some of these industrial names that are more tied to the economy. But when you start taking a look at how long this expansion has actually been underway, we bottomed out at the end of last year, and this expansion now is got almost a year under its belt. Keep in mind that we had the COVID crash, but we've pretty much just nullified the effects of that from a manufacturing perspective. ISM Manufacturing Index is probably one of the key forward-looking indicators that the Fed actually looks at when determining policy. And these guys are based out of Tempe, Arizona, the Institute of Supply Management, and they do a really spectacular job of polling manufacturers and businesses and asking them the questions about their orders and about what they're seeing. And these numbers are very, very accurate, some of the best in the industry. So what we're going to do is we're going to take a look at Caterpillar, we're going to take a look at John Deere, and we're going to take a look at their valuations. The interesting thing I want everybody to take away from this is how important it is to look at valuations from a relative perspective, right? So everybody talks about how technology stocks are so overvalued, how big tech, mega cap tech is overvalued, but nobody's ever said anything about the possibility of Caterpillar or John Deere or other industrial cyclical names being overvalued at this point. And when I look at the ISM Manufacturing Index approaching the 60 mark, that's the first thing that comes to my mind. And so I want to share this with you guys right now. And so the very first thing we're going to do, I actually have a pitch book set up so we can just bump right through here and not waste too much time navigating through menus. I do have a cyclical proxy that we could obviously look at. It's part of the earnings certain select list that I use to basically derive out the earnings certain portfolio. But we're not going to waste any time doing that because the cyclical portfolio itself looks very similar to both Caterpillar and Deere. And what I want everyone to see here is we've got obviously the price line in blue, and you can see we've got the earnings trough here in orange and the recovery. The dotted lines are going to be the forecast estimates. And you can see the cyclicality in earnings for Caterpillar. And obviously you can see that the value investors actually got in right at the bottom of the COVID crash. And you can see they've ridden Caterpillar up fairly high. The interesting thing is this chart is a little bit misleading, and it's not the chart or the design of the chart itself. It just happens to be the way most people look at price and earnings charts. They're not looking at it the right way, and so we have an option in the Zacks research system where you can lag the earnings by 1 year. And so instead of looking at price relative to where we're at for trailing earnings, in other words, if you look at a PE trailing 4 quarters earnings, you would see the distance between this orange line and blue line is just absolutely astronomical. So you'd have a PE multiple expansion on an earnings trough, which is not a valid PE multiple expansion, right? So what I mean by that is the buy side is not looking at trailing earnings here. The buy side is looking forward to this recovery, and they're actually looking out 12 months or more. In the case of cyclicals, they can look out 24 months. But the good news for us is that the growth maintains fairly stable. You can see that we go up 36% and then 28%. So what we're going to do is we're going to lag these earnings by a year. And now if you just look down, we've got a nice visual fit of a PE forward 12-month ratio. And when you look at it this way, this is obviously the proper way to look at it. You can see how Caterpillar's price literally channels that earnings line. And you can see perhaps that the buy side maybe got a little bit ahead of itself in evaluating or at least determining valuation on where these earnings are going. Because the very first thing that's going to happen when the buy side gets a sense that earnings are going to cool down is we're going to get a collapse back down to that earnings line in terms of price. And we see this time and time again. Anytime there's a scare, right here back in 04, we were on fire. obviously the buy side thought things were going to cool down right here at the end of '04 because it literally flatlined for 6 months. We notch up, we flatline, we notch up, we flatline. This is traditional price action of a cyclical stock. And the interesting thing is as we are hugging this earnings line, the valuations are basically implied growth at roughly GDP growth. And so what the buy side is basically signaling to management and investors is that, look, we really don't have any confidence in Caterpillar's ability to deliver on whatever the forecast earnings growth is. So we're just going to assign it a PE multiple of 10, and we're going to wait and see what happens with earnings. Well, you can see exactly how that works, and it works like clockwork. And so the idea here is, if we look at Caterpillar, obviously that ISM Manufacturing Index has just gone parabolic, and so has the price of Caterpillar. And so it would be worth it to take a look at a PE forward 12-month ratio. And if we look at this in absolute terms, I'm going to pull Facebook off of this thing really quickly. And you can see, how these PE multiples oscillate. And keep in mind that you've got to be really, really careful when you're looking at PEs through earnings troughs. So this 2388 is a real PE. It's safe to look at. But when I see a 2388 PE on a cyclical stock like Caterpillar, the first thing that pops into my head is, at a 2388 multiple, I could own a company like Facebook. And if you put Facebook in here as a relative, you can see that Facebook's valuation, it just keeps getting more or less cheaper and cheaper. And Caterpillar just tends to oscillate, and we're getting near the top of its PEF12M range, as I suspected, based on what was going on with the ISM Manufacturing Index. And so if you look at these two on a relative basis, you can see that its median is about a 0.5, and it's currently at 0.92. Again, we've got some periods in here for Caterpillar where we've got earnings troughs. We got to be careful. I don't really like doing that analysis historically with cyclicals. What I like doing is just taking a look at the current points and then dividing each of these by the growth rate. And so the next chart, what we're going to look at is a PEG ratio. So I'm going to take and go back here just a little bit. You can see Facebook is trading at a little bit of a premium in terms of PEF12M. Facebook at a 26 multiple, Caterpillar at a 23. Again, when you're buying stocks and you're allocating assets, the idea is, well, if everyone's telling me that I should be going into cyclical names, I really need to be careful and make sure that these cyclical names are going to continue to perform and grow. Because if they don't, I know that the valuation is going to collapse. And so my alternative at a 23 multiple might be a company like Facebook. Okay, so let's do the analysis. I get it. Facebook's not even in the same sector, but keep in mind how I allocate assets and how I recommend you look at stocks is alternatives. Unless you need an industrial stock, there are alternatives outside of industrials that you also need to evaluate. Okay, you don't have to have a specific sector allocation just because the benchmark has it. That is how we generate alpha. Okay. So what we're going to do is we're going to look at a better measure. So we're actually going to take this PE ratio and we're going to divide it by long-term forecast growth, because that's the real question with Caterpillar is how fast is this thing going to continue to grow? So if we divide that by the 3 to 5 year forecast for growth, and then we divide the two series, you can see that Caterpillar, even though it's trading at a slightly less PEF12M ratio, is trading at a 46% premium on a PEG ratio basis. So that is if we take the PEF12M and actually divide it by that 3 to 5 year long-term growth rate that's been forecasted for EPS. It's trading at a 46% premium. Okay. So we can do the same thing now, right? I always tell my sales team and the support staff to have, companies in their back pocket that they can look at whenever they see a metric that looks very, very similar in another company. They can actually do an apples to apples type comparison. Another alternative to Caterpillar might be a name like Google. Okay, take a look at how stable the PE is for Google versus the cyclicality in PE for Caterpillar. Caterpillar, yes, it's a little bit cheaper. Okay, but when we take a look at it relative to Google and we divide it by growth rates, we can see that Caterpillar is actually 12% more expensive than Google. All right, let's take a step back. Let's go back to Facebook. And let's continue our analysis with Facebook. And we'll come back to Google. Let's take a look at return on equity, right? Everybody says, hey, we need to look at balance sheet quality, right? I get it. But we also need to look at how these companies are returning capital, returning money, earnings per share back to the shareholders, ROE. Here's the interesting point. Caterpillar on an ROE basis, actually a little better than Facebook, a lot more cyclical perhaps, but right now a little better. However, I urge you to dig a little deeper, lift the hood. We can do this with ratio analysis. Look at return on capital, right? Begin to fold the debt scenario in, and now look at Facebook relative to Caterpillar. So if you're looking for clean balance sheets, low debt, right? That's what's always talked about during these pandemic type scenarios that we're in. Look no further than perhaps Facebook over Caterpillar. And you can see that by just simply doing a total debt to cap. Here's total debt to capital, 73% versus Facebook at 0. Okay, so again, these are the alternatives that you need to be aware of. And it's not just Facebook, right? It's not just Caterpillar, it's John Deere, it's Google at that level of PE. So we can do the same exact analysis with Google, right? ROE, Caterpillar's got them. Begin to fold in the debt. Google takes Caterpillar by a whopping 50%, right? Total debt to cap. So if you're looking for low leverage type companies to add to your portfolio, you might want to think twice about Caterpillar relative to Google. Okay. Next one I want to look at, let's roll this tape back to PEF12M. And the second, obviously, bellwether, actually I won't do a PE, I'll go to price and earnings. Second bellwether cyclical name that's actually got a lot less cyclical over the years is John Deere. So what we're going to do is we're going to evaluate this move. And again, same exact move right alongside ISM Manufacturing Index expansion, massive PE multiple. We can see that. We'll quantify it now. And we'll look at this on an absolute basis. In this case, we've got John Deere trading at a 31 multiple. And when I think 31 multiples, I think of companies like Apple and I think of companies like Microsoft. And I look at John Deere trading at a 31 multiple, and with Apple's recent correction, I can actually get Apple for a little bit less. And so everybody's talking about how expensive Apple is, but I haven't heard one person talk about how expensive perhaps John Deere might be. And so something we definitely want to perhaps evaluate. And if we look at that PEG ratio that we looked at for Caterpillar relative to John Deere and Apple, we can see John Deere trading at a 57% premium over Apple. And again, return on equity, Apple has John Deere beat hands down to the tune of more than 3x. And when you take a look at the capital structure, when you fold in debt, it's probably a 5x or better beat on ROC. And again, that can be obviously quantified here with total debt to cap. And so, the idea is, do you own Apple now that it's corrected? Is the growth going to be more stable than John Deere? How would you, evaluate these decisions? And that's what we have to do as money managers. So we can do the same exact thing here with Microsoft. Again, when I think of John Deere trading at a 31 multiple, I think of Microsoft at a 30. And there's obviously valuation ramifications here. So, we hear all the time, Microsoft's expensive. Well, what about John Deere trading at a 61% premium on a PE forward 12-month basis relative to their forecast earnings? This is a huge overvaluation perhaps for John Deere. And we look at return on equity again. It's almost twice that for Microsoft over Deere. Return on capital, you're 4.5 times. And it's been reflected obviously with total debt to cap. So if you want lower leverage, perhaps cheaper valuations, you'd look at a Microsoft over a John Deere. I know it sounds crazy, but these numbers obviously do not lie. And so I'm encouraging everyone to think about how they're valuing stocks and analyzing these things. Think about things a little different. Don't do what everybody's telling you to do, and start buying up perhaps all these cyclical names. A lot of these companies are overvalued. I do have a few names that are worth looking at. I do want to throw out 3 names for everyone. Now that I've thrown cold water all over Caterpillar and John Deere, perhaps. But names like Goodyear Tire. Obviously we've got a lot of stay-at-home going on right now, and the valuation, price, everything reflects that, right? We've had a year-over-year percent change in EPS down like 300%. The forecast is for 2021, it's going to get better, 129%, out to 107% growth for 2022. And guess what? That forecast for growth recovery has not even really been priced into Goodyear Tire yet. So if you're looking to do some bottom fishing in the cyclical patch, Goodyear is obviously a deep cyclical, but perhaps worth a little bit more analysis. Same thing with this next stock. This next company is called Avnet, and a really, really nice forecast recovery in earnings. And you can see that this too has not even been reflected yet in its valuation. And Avnet is literally anything that you could perhaps dream up on a napkin at a restaurant for a technology solution. These guys can help you, whether it's hardware, software, chip related, manufacturing, advertising. I mean, these guys they literally do it all. It's end-to-end outsourcing. So anyway, take a look at Avnet. Next name I would take a look at would be Tyson Foods. And I want to show you the importance with Tyson on this concept of lagging earnings and what happens when you don't. You can see a pretty solid relationship here, but I would urge everyone to lag those earnings, and you can see how solid this relationship gets now. And you can see every single time that the buy side gets a little bit concerned about Tyson's ability to deliver on forecast earnings, this thing crashes back down to the earnings line. And here we are again. So where's the next move from here? Well, it's probably up around here, because it does it every single time. And we've got a nice forecast recovery in store, 14% to 23%, so it's actually accelerating. And I don't see why Tyson Foods wouldn't make that run that it's been doing basically since 2014. So, look a little bit deeper into these types of companies that haven't moved, rather than trying to chase the companies that everyone's chasing in hopes that this recovery is going to accelerate. For these types of companies, it just doesn't always work out that way. So there's definitely other opportunities in the cyclical patch, in hospitality, obviously in the airline space. The idea is, how long do you want to be sitting, and do you really want to try to time the market? And that's my main reason for being more biased towards growthier names. When you start looking at valuations, you're looking at forward PEs, and you're trying to ascertain whether that long-term growth forecast is real when you're dividing it by PEF12M to get that PEG ratio. I would much trust, Apple's long-term growth than I would a Caterpillar or a Deere when we're talking about fiscal stimulus and other external forces impacting perhaps those companies a little bit more than, say, an Apple, where it's more consumer demand driven. So anyway, just things to think about. I'll go ahead and leave you with that for this week, and we'll pick this up again next week. Thank you, everyone.